Hello, and welcome to the latest episode of the Friends of Sanctuary podcast. I'm Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Meredith, Chief Investment Officer of Customized Managed Account Solutions at JP Morgan. Thank you so much for joining us.
Thank you for having me.
Financial advisors, when they're working with their clients, taxes are an important component. And JP Morgan is offering a product to help financial advisors as they are managing for tax efficiency. Can you talk about that product for us, please?
Of course. So JP Morgan has a suite of strategies called Tax Smart Strategies. These are strategies that are powered by 55 IP technology, looking to track an investment strategy. Think of it like the S&P 500. And with that has a dual mandate of one, achieving the same investment results, but also generating tax benefits for clients. It does this by, on a continuous daily basis, going through and looking for opportunities. And if the opportunity presents itself, going through and harvesting losses out of the account to achieve the goals of either stacking those up for an opportunity of offsetting capital gains elsewhere within their portfolio, or helping the client transition their positions from where they have embedded gains and move more closely to the investment strategy.
Why are these products so popular? It seems to me they're becoming even more popular.
Yes. First of all, loss harvesting has been a part of the playbook for advisors for a long time. Typically year end, right? That's one where you're looking for your clients, what opportunities do we have? First, the part of it is that's generating the benefits throughout the year. If you look at the end of the year on the S&P 500, the individual positions, only about 35% of them are down 5% or more, or at any point during the year, 70% of them would be down 5%. The other part of it is technology has really enabled this. The idea of a separately managed account where in past, like mutual funds and ETFs have been the vehicle of choice. And that's partially because of the burdensome on the part of the asset manager for implementing through a separately managed account. Technology is making that where the minimums are getting lower, the fees are getting lower, and it's making it more approachable. And what that allows for the advisors when they're talking to a client, they're trying to figure out how to do their asset allocation, right? They're working through the part of how much do I have in large cap equity, how much passive, how much active. In this case, the passive US equity for the part of that S&P 500 can be not just an asset allocation, but also achieving those tax benefits on a daily basis.
Can you explain how this is different from ETFs? Because ETFs do have tax benefits.
Yeah.
So can you compare the two?
Yeah, of course. So the way to think through this, the part of the benefit of ETFs, of course, transparency, exchange mechanics, but also the lower fees for a lot of them, but also the part of not distributing capital gains like mutual funds. But even then, when you're buying an ETF, part of this is that you're purchasing it at a certain price, you're holding it, it's going to have some dividends, so that'll be some taxable effect, but until the very end, and then you're liquidating at the end, and then you're paying the taxes on it. What's happening with the direct index is it's generating those tax benefits on the journey. So as soon as you put the money to work, there's a potential for harvesting those losses, and then you're basically along the way. And this is part of it where your taxes from capital gains, you don't get it back at the end, right? You're paying them year by year. So the idea is the more you can defer paying those capital gains, the better off your client's going to be on the compounding effect.
How is this different from active strategies? Because essentially years ago, this is how financial advisors used to operate.
Yeah.
So how is this helping the strategies or the advisor again?
Yeah, so the interesting thing is we've also expanded the suite of strategies against active strategies from JP Morgan as well. So like our large cap growth, our US equity strategy, and the principle's still the same. The idea is you want to achieve investment outcome. Case of passive, we offer it for a sense of an index like an S&P 500. For active, we can do it against the manager directed strategy, and having it then where the advisor has their choice. They can still go through and decide how much active, how much passive they want. This idea of having it where we're offering the tax benefits on top of it, though, should be pretty seamless and straightforward. Of the idea of being like, do you want more tax benefits or not? The answer should be, we want more tax benefits.
So can you kind of walk through the process, get into a little bit of the weeds,
Yeah,
a little bit of the
course.
details?
Yeah, sure. So on a daily basis, again, technology enables a lot of this, right? But every client's positions come into our systems. So think of that wherever they're having custody, every single tax lot, we're making sure those are reconciled and good. We have the investment strategy that comes in as well. What are the target positions for that? That 55 IP technology, it's an optimization process that looks at the holdings, looks at the target strategy, looks at the embedded gains of it, looks at the estimated tracking error based on whatever the risk loadings and the risk model is and the characteristics of it. And then it optimizes. It says, hey, what's the optimal trade I can do for my client for that dual mandate of getting either closer to my investment strategy and or harvesting losses. Sometimes there's cash to be put to work and it's going to work that down to the target level, et cetera. But again, the optimization comes through and does a lot of the heavy lifting. Now, it doesn't do everything. Part is at the end of it, we still have a team of portfolio managers and professionals going through and looking at every single one of these and saying, some of it is systematized. We're saying, hey, is it doing what we expected to do of achieving the benefits? Some of it's systematized of saying, did it not achieve the benefits? And then some of it is they're looking at it and shaping the trade, looking for what the client has and saying, is there a way to make this a little bit better? All that then gets set for execution, goes out to market, start the process over the next day.
Getting into the weeds again.
Yeah.
Is this 55 IP looking at the portfolio throughout the day and comparing it to the market, or is it just doing it on a closing basis?
Throughout the day. So there's a part of pricing it, usually after the open. So we allow the market to settle in a little bit. And then we're going through and looking at the positions and then working the trade up and sending it out to market, but not for a market on close. We're typically going through more midday and working on that and sending it out.
And that makes total sense because there can be a lot of volatility intraday.
Yes.
Particularly with specific stocks, and especially as we're filming this, because there's a lot of volatility within the marketplace right now.
There is. And actually the market volatility like this can actually be one of the times where an advisor can talk about the benefits to a client. Similar like Liberation Day last year, right? That was one where it was one of our busiest times. The market selling off like 19% in a very rapid fashion. It was the highest volumes we'd ever seen. That's a good part also of the system being designed with the scale and the operational efficiency of a JP Morgan, which is the ability to go through and handle that type of a load, and having it where we generated losses within that month that exceeded what we saw basically across most of the year of 2024. It was a huge amount of activity for us.
Now, one of the things that your process does in terms of indexing, you can track the S&P 500 in a tax efficient way, but you're not buying all of the 500 companies in the index. Do I understand that correctly?
That's correct.
So how do you optimize? How do you pick those companies to represent the S&P 500?
Right. So back to that process, that optimization in the middle, it's powered by a risk model. Now, a risk model basically is, I'll boil it down to the simplest. It's looking for common drivers of equity returns. The idea being like things like value stocks move a certain way versus growth, large versus small, energy companies versus financial companies.
Certain correlations that map.
Yes, certain drivers of that. And basically what it's saying is, hey, how do I get as close as possible to the S&P 500 on those common drivers as I can by holding a subset of the names, right? So you don't need to hold every single last position. And this matters because some clients, you're working with some accounts that are smaller, some that are larger. But overall, it's also, you just don't need everything. So you want to leave a little bit of dry powder to put money to work. And in case of when you're selling something to loss, you want to have it where you're going to put the money, right? So all of that is using that risk model in the middle that's going to say how you're going to make those choices.
What are some of the use cases that you work with?
Oh, what's really interesting about this, right, is when financial advisors typically looking at a portfolio, and a lot of the times clients are coming to them with existing holdings, right? They have a target allocation they're looking to get to, but the burden in the middle is the taxes and the embedded gains that the client already has. So a key part of this is working with what the client already has and meeting them in the sense of if they're coming with embedded positions or call it existing broad diversified, we can work with that. We can work with ETFs and mutual funds, work with that inside of the positions and have that as working as a completion around it. Even concentrated positions where we can work with those and try to shape the risk around those within the direct index. So the idea being like, if you have one growth name, we'll pair that with some lower beta names, some more like consumer staples and things like that.
Some clients have concentrated positions, whether it's equity that's been handed down through the family or whether or not your employer is paying you through equity. How do you deal with concentrated positions?
Back to that part of completing the portfolio. It's a really important thing because that part of shaping the portfolio around it, what's interesting is that you're not transitioning, like a lot of the times if an advisor was taking a concentrated position and moving to like an ETF, they're simply saying, I'm going to move from, say, that large growth name to that broad diversified index. And to that point, we can take that large growth name and shape it with those low beta names. You're actually buying the most diversifying names for the least amount of tax, which will not straight line you towards the market, but actually get you closer in a more rapid manner, right? So part of the technology that we utilize is the ability to run transition reports. So an advisor can actually see the math themselves of saying, hey, if I want to take this much tax, here's how much tracking error I'll be left with. And then you can start watching it over time and then have the position go closer to it as we're able to harvest more losses and be able to work down that position more over time.
What kind of resources do you provide financial advisors that want to utilize some of your smart tax products?
Yeah. So the tax smart products, we have the portal, which is great for having it of running those transition reports. We also do a lot of thought leadership. So inside our website, we have a number of pieces that are kind of tactical of the reasons for across our indexes, why you may want a large cap versus a small cap, why you may want to international or other. But a big one that we do is someone called Stay One Step Ahead. It actually talks quite a bit about that concentrated position in the transition, talks a bit about the tax loss harvesting benefits. It also talks about the benefits for accessing your wealth, the idea of what happens to these accounts after 10 years and how do you go about in using the account to go through and in a more tax efficient manner pull money out of the account. All those are resources that we provide to advisors to help facilitate the conversations with clients.
What are some of the most common questions you're asked?
How it works, but also what happens after 10 years. To that part of that last stage, this idea of tax lock is a big thing of people where they're like, hey, what is the benefits after a while? Because over time, positions go up, right? The idea is like the benefits of this.
Hopefully they're going up.
Well, that's the thing. Like we did a lot of analysis on it. It was in that Stay One Step Ahead piece. And it's, on average, over 10 years, you're up about 140%. Not always though, like from 1999 to 2009, you're down about 12%. So you're not locked up, but you didn't achieve any of your investment goals, right? But the idea being that when you're up over time, yeah, the benefits of having the loss harvesting do tend to go down over time. We estimate about 70% in the first 5 years and 30% thereafter. But the insights that we've provided is what happens at the end. The idea is when you're up that 140%, we're like, well, first of all, what are you holding? Essentially, you're holding the index that you meant to buy. On average, we had a tracking error of about 30 to 80 basis points, which means you're pretty much in the market. Your positions may be appreciated, but you are essentially still tracking the investment strategy that you were hoping to track, right? Then comes the question of, well, what are you going to do with your investments? And the key insight was like, well, there's really only 3 things you do with them. It's going to either be you liquidate it, get some capital gains in order to utilize it, either for just ongoing living or for some large capital expense. You're either going to gift it, you can give it for charitable to an institution, and or you're leaving it for your estate transfer to your loved ones, right? What we showed was by owning the SMA, the separately managed account that's at direct index and all the positions underneath it, you actually have a variety of positions. You said you don't own all 500, but you have like 350. If you don't own the ETF, far less flexible. You have some additional lots because of what you did with dividends and investing along the way, but you don't have the ability to gift from your Mag 7 or spend from your laggards or your more defensive stocks, right? So having that where we did the research and showed that on a one-time basis, on average, we were able to liquidate about 6% of the account on a tax-free basis. That's a pretty substantial benefit versus having it where everything's embedded with the gains. And we were showing it was essentially with the capital gains, you're up 140%, estimated long-term capital at 23, it was like a 13% tax bill if you were going through and holding in a commingled vehicle. So again, substantial benefit for having it where you're working from the flexibility of a separately managed account.
Past couple of years, we've had a very concentrated market.
Yes.
We've had 10 stocks, 7 stocks, pretty much driving
Yes.
performance. How did the process work when you saw such concentration in the market?
Well, actually, it's not just how the market's doing, it's the dispersion amongst the names, right? So in particular, this year has actually been a great year for loss harvesting. Think the software sell-off. That's an opportunity, even though the market was kind of flattish throughout that time period until we hit the most recent time in the bumps here. But the idea was the market was fairly flat, but software had that massive sell-off because of what AI and the potential disruption to it. We were able to harvest those losses along the way. So the part of concentrated leadership left it where the other names were not appreciating as much. Some of them are up, some of them are down. That allowed us to harvest.
Well, this has really been a phenomenal educational conversation.
Thank you.
So what haven't we talked about that you think is important for advisors to know?
Where this is all going, there's a couple of innovations that are on their way. One being the unified managed account. What we're in the process of doing is building and rolling out the idea of having a models. If people may know the 55 IP models business, and they may know the direct indexing business, where we're headed is putting those together, the chocolate and the peanut butter, right? To have it where you're able to put a direct index into an active strategy that is loss harvested inside of your model portfolio. And that's the UMA offering.
And does that come this year?
Hopefully.
Okay.
And then the next part of this is the long short. There's been innovation on the application of leverage within the loss harvesting, along with alpha generating strategies that allows you to have, instead of that dual mandate, a triple benefit of outperforming the market while also generating like losses for clients and having it where it's risk managed and tracking and broadly an index, but also generating excess return for clients.
It sounds like you're going to try to compete with hedge funds.
It's interesting. It is kind of a hedge fund strategy, but it is more within a separately managed account.
Got it. Well, this has been terrific. We're going to have you back
Thank you.
when you merge 55IP with this indexing product. Thank you again for joining us for such an informative conversation and an important conversation on taxes.
Appreciate it. Thank you.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.